The U.S. economy is in a situation that most people aren't aware of, and shockingly, this includes the Federal Reserve. While many have abandoned the traditional quantity theory of money, there's something happening with the money supply that could spell trouble ahead. Right now, the money supply in the U.S., as measured by M2, is actually shrinking compared to what it was in July of 2022. And this type of contraction? It's rare. It's only happened 4 times since the Federal Reserve was created back in 1913. Each of those previous instances led to severe slowdowns. One of those was the infamous Great Depression from 1929 to 1933. There were others in the late 1920s and 1930s, all of which had recessions tied to them. What does that mean for us today? Well, some economists are saying it's a clear signal that the U.S. economy is heading for trouble, likely slipping into a recession either by the end of this year or early next. Imagine you're driving down a foggy road, unsure of what obstacles lie ahead. That's the position the U.S. economy finds itself in today. The fog represents the current uncertainty, and we might be on a crash course with a significant economic downturn. According to Professor Steve Hanke, a highly respected economist and expert on currency reform, we are all driving blind into what could be a major disaster. Hanke has been vocal about one thing. People, whether it's the general public or the Federal Reserve, are not paying attention to the key issue, the money supply. Now, why is the money supply so important? In simple terms, it's the lifeblood of the economy. Changes in the money supply don't affect the economy immediately. There's often a lag that can last up to 3 years before the effects truly take hold. So, while the economy might seem stable right now, the reality is that we could be standing on the edge of a steep decline. Let's go back to the pandemic for a moment. In response to COVID-19, the Federal Reserve and other central banks around the world pumped a massive amount of money into their economies. From 2020 to 2024, the money supply in the U.S. skyrocketed. In fact, at its peak in February 2021, it was growing at an unprecedented 27% per year. This influx of money fueled a temporary economic boom, sending asset prices soaring and creating a wave of inflation. Steve Hanke, along with his colleague John Greenwood, predicted that inflation in the U.S. would peak at around 9%, and they were spot on. The official data showed that inflation hit its high at 9.1%. Now here's where things start to get concerning. Since July 2022, the money supply has been contracting. Historically, every time this has happened, a recession has followed. The contraction of the money supply throttles economic growth. Yes, it brings inflation down, but at the cost of stalling the economy. Inflation in the U.S. is currently sitting at 2.9%, and Hanke and Greenwood are forecasting that it will end the year between 2.5% and 3%. However, this isn't necessarily good news. In fact, it's a warning sign that the economy is losing steam. With inflation easing, the economy is slowing down, and we could be looking at a full-blown recession. If you're following corporate earnings reports, you're likely seeing a trend. Forecasts are being revised downward, and companies are feeling the pressure. Top-line revenues are shrinking, costs remain high, and profit margins are getting squeezed. Let's talk about the stock market for a minute. Price-to-earnings, PE ratios, which investors use to determine whether stocks are overvalued, are at highly inflated levels. Hanke believes that these inflated PE ratios are ripe for a correction. As companies struggle with declining revenues and high costs, their profit margins will shrink, and will likely see stock prices fall. Forward guidance from many companies is already factoring in these downward pressures, but Hanke warns that they're not accounting for the full scope of what's coming. This isn't just an opinion, it's a historical pattern. When the money supply contracts, inflation drops, but so does economic activity. Time and again, these contractions have led to recessions. The U.S. stock market, as measured by the Shiller-Cape ratio, is currently one of the most overvalued markets in history, about 35 times higher than the average of the last decade. And it's not just Hanke who sees trouble brewing. Warren Buffett, one of the world's most successful investors, has been quietly preparing for a downturn. He's been trimming his stock holdings and stockpiling cash at a record pace. Berkshire Hathaway, his company, now holds more U.S. Treasury bills than the Federal Reserve itself. The economic uncertainty doesn't stop with the U.S. money supply. Global risks are adding to the pressure. Two major conflicts, the war in Ukraine and the growing tensions in the Middle East, are creating further instability. Wars disrupt global supply chains, increase shipping and insurance costs, and inject uncertainty into the market. The conflict in the Red Sea region, for instance, has already led to rising shipping costs as vessels are rerouted to avoid conflict zones. While these risks are priced into sectors like shipping and oil, the broader economic consequences are still largely being ignored. And it's not just interest rates causing issues. Hanke argues that the Federal Reserve's focus on raising interest rates as a way to curb inflation is misguided. The real driver of economic activity, according to Hanke, is the money supply itself. Higher interest rates don't hit every sector the same way. Some companies, especially those with significant cash reserves and locked-in debt costs, are benefiting from the high rates. Take Apple and Microsoft, for instance. They're sitting on mountains of cash and are actually making more money from interest. However, smaller companies are struggling with higher borrowing costs, which is eating into their profits. So, what can everyday investors do? Hanke and other experts are advising caution. Warren Buffett's strategy, for example, is to hold on to cash and wait for better opportunities to buy when the market corrects. In times of uncertainty, cash is a position, not just something sitting on the sidelines. It gives you flexibility and the ability to jump on opportunities when asset prices drop to more reasonable levels. For those looking for safer investments, gold is historically a solid option during economic downturns. It has been trading near its recent highs and serves as a hedge against both recessions and monetary instability. U.S. Treasury bonds, especially the 10-year bond, are another option. With inflation trending down, bond yields are likely to follow, creating capital gains for bondholders. If you're still enjoying this content and finding it valuable, be sure to subscribe to Economic Hero. We dive deep into topics like these every week to keep you informed on the state of the economy and financial markets. Now, as the fog of uncertainty looms large, Steve Hanke's advice is clear. This is not the time to make aggressive moves. While there may be opportunities in certain sectors like technology, the overall market is too risky right now. Stay nimble, hold on to cash, and wait for the economic landscape to clear. For small business owners and everyday investors, Hanke's advice is simple: preserve your capital. If you're in a more vulnerable sector, consider tightening your budgets and delaying major investments until the economic outlook becomes clearer. Ultimately, the U.S. economy is standing at a crossroads and the risks are mounting. The money supply may be shrinking, but the dangers to economic growth are only increasing. For those paying attention, the message is clear. Prepare now, stay cautious, and keep a close eye on what's coming next. If you found this video informative, don't forget to like and subscribe to Economic Hero for more insights on the economy. Stay tuned, stay prepared, and we'll see you in the next video.